Hello friends, let us discuss now one question of admission of partner where new partners admitted and he is not bringing cash for his share of goodwill. Therefore, first goodwill is raised and then goodwill is written off. How to give effect to such adjustment, that will be understanding in this question. Let us go through the question. Akash and Badal were partners sharing profits and losses in the ratio of 3/5 and 2/5. That means profit sharing ratio is 3:2. On 31st March 2012, their balance sheet is as follows. Balance sheet as on 31st March 2012. On liability side, we have sundry creditors 60,000. General reserve 20,000. This general reserve will be divided among old partners, that is Akash and Badal, in the ratio of 3:2. Capital accounts of Akash and Badal, it will be transferred to their partners capital account credit. Asset side, we have cash at bank. If we open cash account, this will be opening balance 1,000. Sundry debtors 90,000 less RDD 1,000. So net debtors are 89,000. Stock 34,000, investment 48,000, plant 60,000, building 88,000. On 1st April 2012, Sagar was admitted into partnership on following terms. So Sagar is a new partner. He should bring 42,000 as his capital. So money is received by business. It will be debited to cash account. Sagar's capital account will be credited. Valuation of goodwill of the firm to be made two times of average profit of last 3 years. The profits were 48,000, 52,000, 80,000 respectively. So we are required to do working note for this. Sagar was not able to bring the goodwill in cash. Hence goodwill was raised in the books of the firm. So full value of goodwill of the firm is raised. Goodwill account is opened. Before admitting Sagar, RDD was to be raised up to 2,000. Current RDD is 1,000. So we are required to add 1,000 more to RDD. So it will become 2,000. This will have one effect, adding 1,000 to RDD. Second effect, revaluation account debit. Closing stock was to be valued at 32,000. Stock here we have 34,000. So it has been revised. New value is 32,000. So 2,000 is reduced. This will be debited to revaluation account, and from asset we are required to deduct 2,000 from stock. Half of the plant was taken by Akash at book value. Akash has withdrawn plant, so Akash account will be debited. Half of the plant is taken by him, so on asset side, from plant will reduce half amount. Plant here is 60,000. Half plant, that is 30,000, is taken by Akash. So this will be reduced. Provide depreciation on building at 5% per annum. This will have one effect, revaluation account debit. Second effect, less from asset on asset side. That is less from building. Building here we have 88,000. 5% means 4,400 is depreciation. This will be reduced from building. Second effect, revaluation account debit. Goodwill is written off, raised and written off after admission of new partner in the ratio of 5:3:2. This is a new profit sharing ratio. Goodwill will be raised in old ratio and written off in new ratio. Prepare profit and loss adjustment account, capital account of partners, and balance sheet of new firm. Let us start posting. On liability side, first item we have sundry creditors. There is no adjustment on sundry creditors. This will be recorded in new balance sheet on liability side as it is. Liabilities, sundry creditors 60,000. Next we have general reserve 20,000. This will be divided among old partners in their profit sharing ratio 3:2. Partners capital account credit Akash Badal in the ratio of 3:2 by general reserve 12,000, 8,000. Next we have partners capital accounts Akash 1,44,000, Badal 96,000. This will be recorded to the credit of their capital accounts. By balance brought down Akash 1,44,000, Badal 96,000. Let us consider asset side. Cash at bank we have 1,000. On asset side, cash is recorded inner column 1,000. Next we have sundry debtors 90,000. There is adjustment on RDD. Sundry debtors 90,000. Current RDD is 1,000. Stock 34,000. There is adjustment on stock. Stock inner column 34,000. There is no adjustment on investment, so it is recorded in outer column. Plant 60,000. There is adjustment on plant. Plant 60,000 inner column. We have transferred all items in balance sheet. Let us go through the adjustment. On 1st April 2012, Sagar, new partner, was admitted to partnership on following terms. He should bring 42,000 as capital. This is amount received by business, so cash account will be debited and Sagar's capital account will be credited for rupees 42,000. On asset side, we have added 42,000 to cash amount of 1,000. Now cash has become 43,000. Another effect of 42,000 will be recorded in Sagar's capital account on credit side. Sagar's capital account credit by cash account 42,000. Valuation of goodwill of the firm to be made twice the average profit of last 3 years. The profits of last 3 years are 48,000, 52,000 and 80,000 respectively. Sagar was unable to bring goodwill in cash. Hence, goodwill was raised in the books of the firm. Adjustment of goodwill. We are required to calculate first firm's goodwill based on number of years purchase method. Accordingly, our first step will be calculation of average profit. Formula is average profit is equal to total profit divided by number of years. In this problem, we have 3 years profit, 48,000, 52,000, 80,000. We are required to divide this by number of years 3. Total profit of last 3 years is 1,80,000 divided by 3. So we get average profit 60,000. Goodwill is calculated as average profit multiplied by number of years purchase. Here average profit we have 60,000. In question they have said goodwill is twice the average profit. So 60,000 multiplied by 2, we get firm's goodwill 1,20,000. This is raised on admission of new partner. So entry will be for goodwill raised, goodwill account debit 1,20,000 to Akash capital account 72,000 to Badal's capital account 48,000. This is divided between them in their old ratio 3:2. As per the information given in the question, we are required to write off this amount. This will be written off in new ratio, which is 5:3:2. Entry is all partners capital account debit to goodwill account. Akash capital account debit 60,000. Badal's capital account debit 36,000. Sagar's capital account debit 24,000 to goodwill account 1,20,000. So these will be the entries for goodwill raised and written off. Let us give effect to this. Goodwill account debit to Akash capital account 72,000, to Badal's capital account 48,000. These will be now then credited to their respective capital accounts. Partners capital account credit side, Akash Badal by goodwill account 72,000 and 48,000. Next step will be for writing off goodwill. Entries for goodwill written off, all partners capital account debit to goodwill account. This will be posted to the debit of all partners. Partners capital account debit to goodwill. Akash 60,000, Badal 36,000, Sagar 24,000. This will have another effect in goodwill account on credit side. Goodwill account credit side by Akash capital account 60,000, by Badal's capital account 36,000, by Sagar's capital account 24,000. Here goodwill account gets closed. So no goodwill will appear in new balance sheet. Before admitting Sagar, RDD was to be raised up to 2,000. Current RDD is 1,000. Raised up to 2,000 means we are required to increase RDD by 1,000. This will have one effect, revaluation account debit to RDD 1,000. This will have another effect on asset side. Debtors we have 90,000. Opening balance of RDD is 1,000, that is old RDD. We have to add 1,000 to RDD amount, so it becomes 2,000. 90,000 minus 2,000, net debtors are 88,000 now. Closing stock valued at 32,000. Stock we have 34,000, revalued at 32,000. That means there is a reduction of 2,000. This will have one effect to the debit of revaluation account. Revaluation account debit to stock 2,000. This will have another effect in balance sheet. Opening balance of stock 34,000 less decrease in stock 2,000, outer column 32,000. Next we have half of the plant was taken by Akash at book value. The value of plant given in the question is 60,000. Half taken means it is of 30,000. This will have one effect to the debit of partners capital account. Partners capital account debit side, Akash column to plant 30,000. This is for plant taken over by him. This will have another effect in balance sheet on asset side. Plant 60,000. Half plant is taken by Akash at book value 30,000. Remaining plant is 30,000. Provide depreciation on building at 5% per annum. Value of building is here 88,000. We are required to reduce 5% of this, which comes to 4,400. This will have one effect to the debit of revaluation account. Revaluation account debit to building 4,400. This will have another effect in balance sheet on asset side. Building we have 88,000 less 5% depreciation 4,400. Net value is now 83,600. Next we have goodwill is written off after admission of partner in the new ratio, that is 5:3:2. We have already given effect to this adjustment. Now we can close various accounts. We can first start with revaluation account. Another name of revaluation account, profit and loss adjustment account. Revaluation account. both are names of same account. Evaluation account is showing loss of 7,400. This is distributed between Akash and Badal in their old ratio 3:2. Akash share 4,440, Badal's share 2,960. This will be debited to their respective capital accounts. Partners capital account debit, Akash 4,440, Badal 2,960. Now we can close partners capital accounts. We have closed partners capital account. We got balancing figure on debit side. Akash 1,33,560, Badal 1,13,040, Sagar 18,000. This will be transferred to new balance sheet on liability side. Here it will be recorded to balance carried down. We have closed balance sheet. Capitals are transferred. Akash 133,560, Badal 1,13,040, Sagar 18,000. Asset side total is 3,24,600. Same is the total of liability side. That means our balance sheet is tally. In this question we learn how to give effect to adjustment goodwill raised and written off. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.